A Roth IRA lets your money grow completely tax-free. You pay taxes once, then never again on any gains. A 401k shields your income from taxes today. Every dollar you put in reduces what the IRS can touch right now. The HSA is the only account with a triple tax advantage: contributions, growth, and withdrawals all tax-free. Tax loss harvesting means selling losing investments to cancel out your gains, legally wiping your tax bill. You can contribute up to $7,000 a year to a Roth IRA. Small deposits, massive future savings. At retirement, every dollar in your Roth IRA comes out 100% tax-free, even if your account grew from $50K to $500K. Many employers match your 401k contributions. That's free money on top of your tax savings. Never leave it on the table. Traditional 401k saves taxes now. Roth 401k saves taxes later. Choosing the right one depends on your future tax rate. In 2024, you can put up to $23,000 into a 401k. Max it out and you've already shielded nearly $25,000 from income tax. Earn too much for a Roth IRA? The Backdoor Roth lets high earners convert traditional IRA funds legally. The Mega Backdoor Roth lets certain 401k plans contribute up to $43,500 extra into a Roth, a hidden superpower. If you're self-employed, a solo 401k lets you contribute as both the employee and the employer up to $69,000 a year. A SEP IRA lets freelancers and small business owners shelter up to 25% of their income with almost zero paperwork. Small businesses can use a simple IRA, easy to set up, employer contributions required, and big tax deductions for the owner. Most people use their HSA for medical bills, but you can invest it and let it grow tax-free for decades instead. After age 65, your HSA works just like a traditional IRA. Use it for anything without penalty. It's the ultimate stealth account. Stack a 401k, Roth IRA, and HSA together and you've built a tax-free fortress that the IRS can barely touch. Real estate is one of the most powerful tax shelters available to regular Americans, and most people don't even know it. Depreciation lets you deduct the wear and tear of a property, even if it's actually going up in value. That's a paper loss. The IRS lets you depreciate a residential rental property over 27.5 years, creating a deduction every single year.
Commercial properties depreciate over 39 years, still a massive annual deduction for business owners and investors.
A cost segregation study accelerates your depreciation, letting you front-load years of deductions into year one.
Yes!
Bonus depreciation lets you deduct a huge chunk of a property or asset's value in the very first year, immediate savings. A 1031 exchange lets you sell a property and reinvest the profits into another without paying capital gains tax. You can chain 1031 exchanges indefinitely, rolling gains from property to property and never paying tax during your lifetime. When you pass appreciated property to heirs, the cost basis resets to today's value, meaning the capital gains tax disappears entirely. Rental losses can offset rental income, reducing your taxable income from real estate to near zero on paper. If you qualify as a real estate professional, your rental losses can offset any income, including your day job salary. Short-term rentals like Airbnb properties can unlock non-passive loss treatment, even without RE professional status. Qualified opportunity zones let you defer and reduce capital gains taxes by investing in designated low-income areas. Hold a qualified opportunity zone investment for 10 years and any new gains become completely tax-free forever.
Hold a qualified opportunity zone investment for 10 years and any new gains become completely tax-free forever.
A $400,000 rental property generates roughly $14,500 per year in depreciation deductions, tax-free cash flow against any gains. Real estate lets you use borrowed money to control large assets and still claim depreciation on the full value, not just your equity. Between depreciation, 1031 exchanges, and cost segregation, real estate is the most tax-efficient wealth builder in America. Business owners have access to hundreds of legal deductions, turning everyday expenses into tax write-offs. If you work from home, a dedicated office space qualifies for a deduction, reducing your taxable income every year. A heavy SUV or truck used for business can be fully deducted in year one under Section 179, worth tens of thousands. Electing S-Corp status can save self-employed people thousands in self-employment tax by splitting income into salary and distributions. The key to the S-Corp strategy is setting a reasonable salary, high enough to satisfy the IRS, low enough to minimize SE tax. The Augusta rule lets you rent your home to your own business for up to 14 days per year, completely tax-free rental income. Pay your children to work in your business and shift income into their lower tax bracket, legally reducing the family's total tax bill. Business owners can set up a defined benefit pension plan and shelter over $200,000 per year from taxes, legally. Pass-through businesses get a 20% deduction on qualified business income, one of the biggest tax gifts in recent history. Self-employed people can deduct 100% of their health insurance premiums, reducing taxable income before even itemizing. Business meals are 50% deductible, meaning the IRS essentially pays for half of every client dinner you document. Business travel, flights, hotels, transportation is 100% deductible when the primary purpose is business. Plan it right. Computers, cameras, machinery, any equipment used in your business can be depreciated or fully expensed immediately. Donating appreciated stock to charity avoids capital gains tax and gives you a deduction for the full market value. A donor-advised fund lets you take a big tax deduction now and distribute the money to charities over time. Maximum flexibility. A conservation easement donates development rights on land to a nonprofit, creating a large deduction while keeping the property. Run a business, you have access to deductions, retirement accounts, and structures that can reduce your tax rate to near zero. Long-term capital gains are taxed at 0%, 15%, or 20%, far less than ordinary income tax rates. Time is your biggest ally. If your taxable income is below $47.25 as a single filer, your long-term capital gains rate is literally 0%. Hold any investment for more than 1 year and your profits automatically qualify for the lower long-term capital gains rate. Have a low income year? Harvest your investment gains while you're in the 0% bracket. Pay absolutely nothing. Sell losing positions to realize losses, then immediately buy similar, not identical assets to maintain your investment exposure. Watch out, the wash sale rule blocks your loss if you repurchase the same or substantially identical asset within 30 days. Donating appreciated stock is more powerful than donating cash. You avoid capital gains and get the full deduction. Spread the sale of a business or property over multiple years via an installment sale, keeping each year's gains in lower tax brackets. Both QA's investments and 1031 exchanges defer capital gains, but QA's can eliminate new gains entirely after 10 years. You can gift up to $18,000 per person per year completely tax-free. A simple strategy to move wealth without gift taxes. In low-income years, convert traditional IRA funds to a Roth. Pay tax now at a low rate, never again in retirement. If you hold company stock in your 401k, the NUA strategy can get you capital gains rates instead of ordinary income rates. Time your sales, harvest your losses, use the 0% bracket, and donate appreciated assets. 4 moves to keep capital gains taxes minimal. Federal estate tax only applies above $13.6 million per person. Most Americans will never pay it, but planning still matters. An ILIT removes life insurance proceeds from your estate, keeping a large death benefit out of the taxable estate entirely. A GRAT lets you transfer the growth of assets to heirs gift tax-free, if the assets appreciate faster than the IRS hurdle rate. A family limited partnership transfers assets to family members at a valuation discount, reducing gift and estate taxes. A 529 plan grows completely tax-free and withdrawals for education are never taxed, a powerful generational savings tool. You can superfund a 529 with 5 years of gifts up front, up to $90,000, removing it from your estate immediately. Systematically gifting $18,000 to each family member every year quietly shrinks a taxable estate over time. A dynasty trust can hold assets for multiple generations, passing wealth to grandchildren and beyond without repeated estate tax. Paying someone's medical or tuition bills directly to the provider, not to the person, is excluded from gift taxes entirely. A surviving spouse can inherit their deceased partner's unused estate tax exemption, effectively doubling the threshold to 27M. A slat lets you move assets out of your estate while your spouse still has access to the funds. Best of both worlds. The wealthy don't just earn more, they use trusts, gifts, and structures to pass wealth across generations nearly tax-free. Investments in oil and gas can offer up to 100% deduction of drilling costs in year 1, one of the most aggressive shelters available. Storing a certified historic building earns a 20% federal tax credit, a dollar-for-dollar reduction directly off your tax bill. Investing in low-income housing developments earns federal tax credits that directly offset your tax liability, dollar for dollar. Under Act 60, U.S. citizens who become genuine Puerto Rico residents pay just 4% corporate tax and 0% on capital gains. Qualified small business stock can exclude up to $10 million in gains from federal tax entirely, if held for at least 5 years. Small businesses can use an HRA to reimburse employees for health costs tax-free, deductible to the business, tax-free to workers. A captive insurance company lets businesses pay premiums to their own insurer, creating deductions while building tax-advantaged reserves. A self-directed IRA lets you invest retirement funds in real estate, private equity, and more, all growing tax-advantaged.
Waiting until 70 to claim Social Security increases your benefit by up to 76%, and smart income.
High earners pay an extra 3.8% net investment income tax. Keeping income below the threshold avoids it entirely. The bunching strategy groups multiple years of deductions into 1 year to exceed the standard deduction, maximizing your itemized write-offs. 9 states have no income tax at all. Moving from California to Texas or Florida could save tens of thousands annually. From QSBS to captive insurance to no income tax states, the advanced tier of tax strategy is available to anyone willing to learn. You don't need to be wealthy to start. Open a Roth IRA today. Contribute to your 401k tomorrow. That's all it takes to begin. A great CPA doesn't cost money. They make money. The right advisor finds deductions that pay for themselves. Stack strategies together. A 401k reduces income, an HSA adds more, real estate depreciation adds more still. They compound. Tax strategy isn't just for April 15th. The decisions you make all year determine what you owe. Plan proactively. The gap between the wealthy and everyone else isn't just income, it's tax knowledge. Now you have the knowledge too. Share this with someone who needs it. A friend, a parent, a sibling. Tax strategy is a gift that compounds over a lifetime. Every strategy in this video is IRS approved. The government built these rules intentionally. Using them isn't a loophole, it's the law. Subscribe for more strategies. Your financial future is being decided right now by the decisions you make today.